Now.
Well, good afternoon, everyone. I am Kamie Zaracki, the CEO of Better Investing, and I'm delighted to have you join us at the Women Teaching Trading and Investing. I'm going to teach you a little bit about investing. As you can see, my presentation is about common sense steps to evaluate stocks for growth and return. A quick disclaimer before we get started. Of course, any of the stock references that I'm going to make during today's presentation are for educational purposes only. I'm not intending to make a recommendation to either buy or sell any particular stock. We, of course, at Better Investing, encourage everyone to do their own analysis before they make an investment decision. And the stock quotes that you will see in my presentation today are as of January 15th, 2020. This is today's agenda, and we'll be going through each one of these topics in turn. So let me tell you a little bit about Better Investing. We are a nonprofit association of individual investors and investment clubs. We've been around since 1951. We are really focused on supporting our members. We work with a large group of volunteers around the country. We've got 47 chapters around the country and over 600 volunteers that staff those chapters. And our mission is really all about creating successful, lifelong investors. We are all about teaching people how to invest for the long term. So having said that, that means that you should think of us as fundamental investors. And as being fundamental investors, these are the things that we think about. We actually view our investments on a long-term basis. So in general, we plan to hold our investments for at least 5 years. That's not a hard and fast rule. Sometimes our members will hold stocks longer than 5 years. Other times we'll hold stocks for less than 5 years. But pretty much that's what we shoot for. We focus on the company's performance, both what they've done in the past, so in other words, what their proven ability, as well as what we think they're going to do in the future. And we don't get all caught up in the emotional swings of the market. The last few days being a very good example of that, of how crazy the market can be. We focus on the earnings because we believe that earnings are the ultimate driver of a stock's price. Now, that doesn't mean that they necessarily move hand in hand. Sometimes a company will be generating great earnings and the stock price will be what we would consider a little lackluster. So in other words, we don't see the growth. But time and again, we see that eventually the stock price will start to reflect the earnings of the company. And most importantly, we'll only consider buying a stock when it's selling at a reasonable price. And that's really the key thing. If you pay too high a price for a stock, it may have been a great stock to own, but if in fact you paid too much for it, you're not going to get the return that you're looking for. So we really focus on trying to make sure that we are buying the stock at what we believe to be a reasonable price. And we believe that if anybody can learn to become a successful long-term investor. So these are our principles. We invest regularly, and as a result of investing regularly, we don't get all caught up in the swings of the market. This enables us to dollar cost average, which means that if we're buying a particular stock regularly over a period of time, there are going to be some purchases that we make where the stock price is low, which is what we like. Sometimes when the stock price is going to be a little bit higher, but on average, we're going to be able to buy the price buy the stock at a lower price. We also reinvest all of our dividends and earnings. And of course, we do that so that we can take advantage of compounding. So that's that same concept that we have with interest on our accounts that we have in any bank. But of course, if we're reinvesting our dividends and earnings, our compounding is occurring at a higher rate. And that's really how we get our money to work for us, is through reinvesting all of our dividends and earnings and so forth. We invest in quality growth stocks at reasonable prices. I find that many people have a pretty good intuitive sense of what makes a good quality stock, what happens is, as I mentioned before, we have a tendency to pay too high a price for it. So as a result, while we may have purchased a good stock, we're not getting the return that we're looking for from that particular stock because we paid too high a price for it. So many times we will focus on a particular stock and then we'll wait for the price of the stock to drop. As long as all the other fundamentals with the company are still good, we view a drop in price as actually being very positive. It's kind of an indication that the stock has, quote unquote, gone on sale, if you will. So that's definitely something that we look for. And of course, we diversify our holdings to help mitigate the risk that's inherent in owning stocks. And we target, we try to have a balanced portfolio that consists of 25% large company stocks, 50% medium company stocks, and 25% small company stocks. And of course, we like to see them spread across generally, all the market segments that are out there. So what is it that Better Investing members do? We can see these specific steps, and we're going to talk about them in turn, so I won't go into them right now. And we'll start with the very first one. We search for quality growth stocks. And there's many ways we go about doing that. Some of our members like to look at the prospectuses of specific mutual funds and take a look at the holdings that they have to see if that gives them some ideas for stocks that they might investigate further. We take a look at Fortune's fastest growing companies. That's a great way to get some ideas for potential growth stocks. Also take a look at stocks that are featured in different magazines. Money and Kiplinger's, which I'm sure many of you in the audience are familiar with. If there are any Better Investing members in the audience, I'm sure you're familiar with Better Investing magazine. But this magazine, Better Investing, is a magazine that we make available to our members, and that magazine features, of course, many stocks in every issue. And then, of course, we'll take a look at stock screeners that will help us to identify stocks. So a stock screener is obviously an automated tool. We'll put in different criteria that we're looking for in terms of growth rates, return, maybe a particular industry segment, and so forth. And the screener will serve up the stocks that meet those particular criteria. Many people are very successful too in getting ideas for stocks to buy based on the products that they use. So in other words, they find a product that they like and it works very well for them. They think very highly of the company and they might say, hey, I'm wondering if this makes a good stock to buy, and then they will go and investigate that further. And that's really a key thing to keep in mind. Just because somebody says a stock is a growth stock doesn't mean we need to take it at face value. It means that we need to take this second step and verify the quality and growth of the stock. And what you see here are the different things that we look for. So we're looking for strong and growing sales. We have different target growth rates based on the size of the company. And so as you see, the larger the company, the slower the growth rate that we would expect for that particular company. Now, I will also tell you that we can think of some very large companies that are growing greater than 7%. And in fact, some of them are growing at greater than 12%. And that's great for them, but not all, but we can't all own those companies, or we don't want, I shouldn't say it that way. What I mean is we don't want a portfolio that only consists of those companies because it potentially could be carrying a lot of risk for us. And so again, we want to try and have this mix of large, medium, and small companies in our portfolio. We look for strong and growing earnings. They don't have to grow at exactly the same rate as the sales, but we like to see things moving in the same direction. We like to see steady or growing pre-tax profits and return on equity. Again, that's an indication of how profitable the company is and the return that we as shareholders are going to get through the return on equity. So again, that is those are other important things that we look for. And we also take a look at the debt picture. We like to see steady or declining debt to capital. And so those are the things that we look for. And now we're going to get to the portion of the presentation where we start to see how some of this comes into play. Now I have to say, normally when I give this presentation and I'm with a live audience, I'm usually doing things kind of face-to-face instead of online when I give this particular presentation. This is what I call the audience participation portion, where we jointly analyze the sales and growth of a particular company to see if it meets our criteria for quality growth. So let's start by taking a look here at this particular company, number one. It's a consumer defensive company. And I should say what you're taking a look at here is a screenshot of our stock analysis tool. We refer to it as the stock selection guide, or sometimes we'll just abbreviate it and call it the SSG. So just to understand how to read this chart, the green line is the sales line. So of course we're tracking sales for, we've got 10 years worth of history here. At a minimum, we like to see 5 years of history, but we prefer 10. We have this blue line, which is the earnings line for this company over the last 10 years. The pink line is the pre-tax profit line. These are the price bars that show during that particular year what the high and low price was for the company. And generally, we like to see everything moving up and to the right. Now, on this particular chart, you will see those little dots that are sort of blank on the inside, so they look like little donut holes, if you will. What that is indicating is that this particular company, at the time that I pulled this, which was on January 15th, that this company had not yet reported fourth quarter results. And so what we see is the results that were reported for the first through third quarters for this particular company. A couple of other things I would point out over here on the right-hand side is some additional information. We can see what the growth rate is for this particular company in both sales and EPS. And then I've also identified what the annual sales were for this company. This would be reported in 2018. So you should be asking, you should be saying to yourself, okay, this company is generating $3.8 billion in sales. So that means it's a medium-sized company. We know from our previous chart, we want medium-sized companies to grow between 7 and 12% annually. We see that this company is growing at 11.6% or just under 12% annually. So that exceeds, that's right there in the range that we're looking for. So we would say that this company is a quality growth company. Okay, let's do this a couple more times. So on company number two, it's a healthcare company. So one of the first things you should notice is that the lines are not all smooth and they're not moving up to the right. They're actually very erratic. And in 2018, they didn't have any earnings at all. And so this particular company, it's a small company generating $500,000 in sales. So it's a small company. You should be saying to yourself, it's a small company. And you should be saying, okay, the small company, we're looking for greater than 12% growth in order to consider this company a quality growth company. And that's not what we're seeing. In fact, their sales are plummeting. So we would not consider this a quality growth company because it's not growing at the rate that we expect and it's not growing smoothly. Everything's erratic. We don't see all of the graph lines moving up and to the right. Okay. Let's take another look here. Company number three. So again, this company is generating $575 million in sales. So we would consider this a small company. So we're looking for a growth rate of greater than 12%. And we can see here that the company is growing at a negative 3%. And just looking at this revenue line, we can see that very clearly that it's dropping off and it's not growing the way we would like it to. And of course, the other thing that we notice about this is that the earnings are dropping off, the pre-tax profit is dropping off, and we see that the price is declining on this particular company as well. So again, we would not consider this company a quality growth company. And we've got one last company to take a look at here. It's a manufacturing company, completely different size. It's generating 32.8 billion in sales. So we would consider this to be a large company. And so for large companies, we like to see a growth rate of 5 to 7%. And that's not what we see here. We see a negative 2%. And again, we see that just by taking a look at the line. You know, it was improving a little bit, and now it's starting to dip again with this particular company. And the other thing that we notice is that the earnings line is a little erratic in the last year. It took kind of a hit. We'd certainly like to see it improve. And same with the pre-tax profit line. We can see how it came down and so forth. So we would conclude that this company is not a quality growth company. So what we've just conducted is a visual analysis of 4 different stocks. And the thing that you should be taking away from this is that we've already determined what company we should spend more time trying to understand. It's company 1 because it met our first criteria of being a quality growth company, because it had strong and growing sales and strong and growing earnings, and everything was kind of nice and smooth and moving up to the right. We haven't crunched a number. We haven't done any analysis other than this visual analysis. And I think that's one of the really great things to understand as fundamental investors when you take a look at the way we do things at Better Investing. Because it starts to me make a lot of comments. It makes a lot of sense to people. They can understand why we're coming to the conclusions that we are about each one of these companies. So now we're going to talk about this company in depth and go through the rest of the analysis that we would do with the stock. So this particular company is Monster Beverage. Hopefully all of you on the call today have seen examples of Monster Beverage in the grocery store. It's an all-natural beverage company, so no soda. And it operates in a growth segment. Actually, it operates in a segment that has 27 years of increasing sales. So that's really great. So, you know, whenever you get ready to invest in a company, it's important that you understand a little bit about how the company makes money. You don't necessarily need to be an expert in the company, but you need to understand some basic things. You need to understand what the company does. We have that right here, all natural beverage company. You need to understand their sources of growth. And we've got that here in sort of the first 3 or the next 3 bullet items. The first one is that it's operating in a growth segment. So it's one of the reasons why it's a quality growth company is because it's operating in a segment that happens to be growing. So that's really positive. Also, this company has a partnership with Coca-Cola, which is allowing them to expand their international reach. So Monster Beverage is a smaller, or I should say a medium-sized US-based company. They've got this partnership with Coca-Cola. So Coca-Cola distributes Monster out through their distribution channels, both inside the country and outside the country. So it really expands the reach for this medium-sized company and gives them the opportunity to grow even further. The other thing is that this company uses product innovation to keep pace with customer preferences. So product innovation in the beverage segment, it can be things like the things that the health elements that they add to the drink. Caffeine is one. I think caffeine is actually the main ingredient in Monster that gives people their energy. Amino acids, electrolytes to kind of balance things out in the body, herbs and other things. They also are experimenting with new flavors and creating new brands and so on and so forth. So again, the company's investing in product innovation to keep the product line fresh and interesting to their clients, to their customers. And then of course, they're very focused on marketing the product. So they're not just relying on this distribution relationship that they have with Coca-Cola. They're also investing in marketing where they're sponsoring specific events or people who are interested in health drinks. They look for their sponsors, they look for social media influencers, and so on and so forth to help them get their name out in front of whom they believe to be their target audience. So at a very high level, we get a sense for what Monster Beverage, the company, does. And how they, what they do in terms of producing different all-natural beverages and the sources of growth, and how they try to sustain that growth and increase their reach and expand their audiences. The other thing that we like to do as a Better Investing member and investor is we want to get some additional evidence on projections in terms of how the company might perform into the future. So we just took a look at that screenshot of the stock selection guide where we saw that we had 10 years of companies' performance history in sales and earnings and pre-tax profits. So what we need to do now is to project 5 years into the future. I had mentioned a little bit earlier that we like to hold our sales for, or excuse me, hold our stocks for about 5 years. So we want to project 5 years out into the future. And that really is giving us, what we think is going to be a 15-year track record. So we can have more confidence in what this company, how this company is able to perform. So as individual investors, sometimes we don't have access to all the information that we might have, that we might like. And so we will take a look at what the analysts have to say about a particular company. And so what you see here are the analyst consensus estimates, the ACE estimates. That comes to us from Morningstar. Morningstar is the company that we get our company data from that is automatically fed into our tool that I showed you a minute ago. And so Morningstar, collects the estimates from various analysts and gives us these averages. So we can see that here, sales being 9.4% and EPS growth being 12.5%. We also like to take a look at Value Line. Value Line is estimating future sales growth at 10% and future EPS growth at 14.5%. There are other places you can go to get projections on these particular in these particular categories. You can go to your online brokerage. A lot of online brokerages make different analysts reports available to their subscribers. So that's one place to go and get more information from the analysts. You can also go to the company's investor relations website and see what kind of information they are sharing there. So you start to get a sense for where you can go to get some additional information to help you make an informed judgment about how you think the company is going to grow into the future. So let's just remind ourselves about verifying the quality and growth for Monster Beverage. So just reminding us, the green line is the sales line, the blue line is the earnings line. We got the price bars. I want to reinforce that it's really important to really take a look at that sales line, because we know that eventually price follows earnings and earnings follow sales. So it all begins with sales. I want to highlight a couple of other things over here to the right. A minute ago, I highlighted the quarterly growth rates that we have for this particular company. That's what we're getting from Morningstar. And here are the analyst consensus estimates right here below. So you can see that too. So very easy to find on this particular tool. Now we want to move on and evaluate management. So, when we talk about evaluating management and their ability to manage the company and the way we would like them to, we're not talking about making a subjective, do we like this person or not? We really want to take a look at some objective criteria. And that's what you see here. And again, we get this from the tool. We take a look at, so in the area of pre-tax profit on sales, we take a look at the last 5 years of reported pre-tax profit on sales. We come up with the 5-year average. we compare the most recent reported results to the 5-year average. And if it's growing or basically flat, we say good. If it's declining, we're not too happy about that. Same thing with return on equity. Same kind of analysis. Compare the most recently reported earnings to the 5-year average. Like to see the most recently reported earnings to be higher than the 5-year average. At the very least, we want it to be flat. And then debt to capital, we like it to be low. But I need to highlight something about debt, because not all debt is bad. Sometimes it makes sense for a company to take on some debt. It gives them the opportunity to invest in their future. Some particular industries actually require a lot of debt. Think of different utilities that have a lot of debt. What's really important is the company generating enough cash flow to be able to service their debt. And of course, you want to make sure that the company is investing in their future. Now, we know with Monster, from a couple of moments ago, that they are investing in their future. They're investing in different product innovation. They're investing in different marketing activity and so on and so forth. But more importantly, they're investing in product innovation, but yet they're not taking on any debt. So what that's telling you is that they are self-funding their investment in the future, which is a great place to be with this company. So in this case, we would say that the quality of the management for Monster Beverage is pretty good, because we're seeing either flat or growing pre-tax profits. We're seeing growing return on equity, and of course, there is no debt. So this is a picture that we'd like to see. Now we're going to go on and estimate the potential for this particular company to grow into the future. And what we're going to do is forecast what we think the sales growth will be 5 years into the future. We're also going to forecast historical earnings per share 5 years into the future. And this is just a reminder of what the analyst told us. And in this particular case, I'm not going to get too fancy. I'm just basically going to go with the midpoint between these two numbers and plug them into the tool. And that's what I've done here. And what you see that the tool has done is that it's extended the sales growth rate out into the future and the earnings growth rate out into the future. And it's also given us an estimate for the 5 years for sales growth and EPS as we go forward. So we have those numbers. Then we want to go on, and our next step is to determine whether or not this stock is selling at a fair price. And so we do that because we want to evaluate the reward versus the reward associated with holding a stock versus the risk associated with holding a stock. And because what we like to see is that the potential reward is 3 times as great as the potential risk. And if that is the relationship that we see, then we say that the stock is selling at a reasonable price. So in doing that, we need to analyze the price earnings ratio for Monster Beverage. And that's what we see here. Again, this is coming from the tool, and I'm just taking one section of it and blowing it up so we can actually see it. And it's not such an eye strain. And we're going to take a look at the price earnings history over the last 5 years for this particular company. And just to understand how to read this, you have the high and the low price for the last 5 years laid out here. You have the earnings per share for the last 5 years in column C. And then in columns D and E, we have a high PE ratio, and the calculation for that is simply the number in column A divided by the number in column C, and that gives us 41. So in other words, $1 of earnings is selling for, that means that a share owner or the market was willing to pay $41 in the stock price for $1 in earnings for this particular company. And then we have the low price earnings ratio, and we can see that calculation here. It's simply column B divided by column C, so we have those numbers. And if they were producing a dividend, we would have that. If they were producing a dividend, we'd see the payout and the yield. But this company is not generating a dividend, and so that's why we see zeros in those numbers. We also have the average for all those numbers, and we have the trailing 12 months earnings for this company, the average PE ratio, and the current PE ratio. So just to remind ourselves of everything, we've got the average high PE of 45.9, the average low PE of 29.6, 5-year average of 37.8, the current PE of 33.1, the average low price of 36.6 or $36.60, and the current price on January 15th was $65.88. Okay, so now I'm going to show you how we use all that information to help us determine whether or not this stock is selling at what we believe to be a reasonable price. So now we're going to estimate the potential high price. Actually, what we're going to end up doing over the next couple of charts that we're going to look at is we're going to estimate the potential range of prices that this stock might trade at. So we're going to start by estimating what we think a potential high price will be, and then we will estimate the potential low price, and then we are going to break that range between the low price and the high price into four different quartiles, four different quartiles, so that we can understand where the stock is currently trading. So again, I'll show you how all that comes together, but we're going to start with estimating the high price. So that's right here, and you can see what the calculation is right here, so everybody can understand the logic behind estimating what the future high price might be. And so again, just taking a look at this, we've got the 5-year average PE of 45.9. We've got the average PE of 37.8. Current PE is 33.1. So in this instance, what we see is that this stock's current PE, 33.1, is trading less than its 5-year average. So to be conservative, I like to be conservative when I'm doing my estimates, I decided to go with just the 5-year average high PE. Or another way to say that is that I believe that this company's stock price and PE will revert back to its 5-year average. And so that's actually what you see here. So I've just put in the 38, just rounding up this number. The high EPS forecast, that was actually calculated for us on the previous couple of charts ago when we estimated what the future sales growth was going to be for the next 5 years, and it gives us the high stock price forecast of $126.20. Okay, so we see that added. Now we're going to estimate the low price that we think this stock might trade at over the next 5 years. And there's several different ways in which you can go about calculating the low price. All of them are valid. In this particular instance, I decided to go with the 52-week low price. And the reason why I'm doing that is that if you take a look at the low price that's shown here under the recent market low, is that the low price of the stock is increasing. So I don't need to wait for this stock to go back down to 41 to think that it's potentially going to be a buy. I think if it gets in the neighborhood of 52, that is going to be low enough and that the stock is going to continue to grow into the future. So in this particular analysis, I chose to go with $52 as the future low price. And so that is in fact what we have here. The high price of $126 and the low price of $52. Now you can see on this red, yellow, green chart that is exactly what is overlaid here. And so and you also see this under the zoning section right here, so you can understand how it all comes together. We define the buy zone to be the first quartile of this range from the forecasted low price to the forecasted high price. So that's between $52 and $70.50. The hold zone is the middle 50%, and the sell zone is the last quartile of this. And so So this is what we have here. We've overlaid the current price of the stock. This is as of January 15th. What I would tell you is I did go in and check. Actually, last week when I started preparing for this presentation, at the price of the stock at that point in time last week was exactly the price that it was on January 15th. And of course, since that time, the market's been a little volatile, but we've also seen the market recover a little bit. And the current price of this stock is actually $68.05. So it's still within the buy zone, according to these judgments that you see here in terms of what we believe a forecasted high price might be and a forecasted low price might be based on the way we think this company is going to grow into the future in terms of sales and earnings per share. The other thing we have here is to note is we call it the upside downside ratio, or in other words, the potential gain that we will get if we buy the stock at this particular price versus the loss. And what we see here is that we have a potential gain of 4.3 to 1, or in other words, we have the potential to earn 4.3 times what we've invested in this particular stock. So we like that. So we would say that that's in the buy zone. At a minimum, we like to see a 3 to 1 ratio. So just to kind of understand how that comes together. And of course, we're taking a look at the price target for this particular stock. We see that with Monster and at the current price as of January 15th, that there's a potential for a 91% appreciation in the stock price. So you get a sense here for how we go about analyzing a stock following the Better Investing principles and the methodology that we use with our stock selection guide. And what we would say for this particular stock, Monster Beverage, is that we're going to go back and verify all those things that we're looking for. We see that they have strong and growing sales. For this size company, we want them growing greater than 7%, and we see that they're almost growing at 12%. We like to see strong and growing earnings. We saw that. We want to see steady or growing pre-tax profits. Same with return on equity, and this company has no debt. So based on the analysis that we just did, we would say that Monster appears to be a quality growth company, and it's currently selling in the buy zone. So hopefully you're getting a sense for how we go about analyzing stocks following this particular methodology. Hopefully you think that it's easy to understand. I would say that actually I do believe it's easy to understand because we haven't done any complicated math here at all. It is, however, a different way to think. And so many times I encourage members and people who are thinking about investing using our particular approach to just practice a lot with studying stocks before you get ready to invest in one, so you can really kind of retrain your brain in terms of how to think about investing in quality growth stocks. I want to take a few minutes here and share some resources that Better Investing makes available to investors. Now, Better Investing is a membership-based organization. We have, so some of our resources that we have available are available to members only, but we make a lot of our resources available on our public website. So I really encourage you to check those out. We have a program that's called Open House, where you can go and sign up and kind of kick the tires a little bit and try different aspects of our membership. You get the chance to take some of our educational programs. You can listen to our educational programs. Most of them are done by webinar. You get the opportunity to download a copy of the magazine that we publish for our members. There's a version of the stock selection guide tool, the analysis tool that I just walked us through. So there's an opportunity, like I said, to kind of kick the tires and see all that's involved. I want, in the spirit of full disclosure, I want to let everybody know that if you sign up for Open House, you're going to get a series of email messages from us. And those messages are going to encourage you to go try different aspects of our membership. And those messages will be sent to you over a period of 90 days. And of course, at the end, we'll give you the opportunity to join the organization if you're ready to, and if not, that's okay too. We also have a lot of online learning events that we make available, and you can see the link there. Better Investing is also an organization that works with investment clubs. We find that investment clubs are a great way to help people learn about investing. And that is because of the rigor that comes with an investment club. And when I say rigor, what I mean is investment clubs get together monthly. They're investing a small amount of money each month, maybe $50. And together they are analyzing stocks. So they're learning together, they're discussing the stocks, they're discussing each other's analysis of particular stocks and their judgments and so on and so forth. And in the process of doing that, it really helps people kind of internalize the philosophy that we have within Better Investing, as well as the approach that we take that I just demonstrated today. So everybody gets the opportunity to practice and use it a lot. And everybody then becomes more comfortable with it. We also make, because we focus on investment clubs, we also have a series of products that help investment clubs operate. And so that's where you can get more information on that. I would also point out we have other investing resources that we like to highlight. You can get a lot of great information off Yahoo Finance, now Value Line and Morningstar, and Investor Advisory Service are also subscription-based products, but these products make great information available to investors off their public website. So we like to encourage people to go check that out. You can get some great learning from that. And then there's also the virtual investor conference that's available. Now, as a special thank you for attending this session, we're making available to all the attendees who are not currently Better Investing members the opportunity to sign up for a free 90-day digital core membership. So you will have access to all the resources that our members would have access to. So you'll be able to work with our stock analysis tool. This particular stock analysis tool is really designed for people who are learning this particular approach. So it takes you step by step through the process. It explains everything as you go. And it really helps you, again, kind of internalize everything. So you understand exactly what you're looking for. You're understanding what kind of judgment you're making when you're analyzing the stock. We make our educational programs available, digital version of the magazine, and so on and so forth. Again, with this particular offer, when you sign up for it, we will also be sending you email messages over the course of those 90 days. And again, encouraging you to go try different aspects of membership. We want to make sure everybody gets the chance to try it and learn, and learn from it. And then at the end of the 90 days, you can make a decision as to whether or not you would like to join the organization. And of course, we would make that offer at a discount. So that's the link that you see before you to sign up for this particular offer and learn more about it. So if you're interested, I would encourage you to do that. If there are any Better Investing members on the call, please feel free to share this 90-day offer with other people. That's a great thing to do. So with that, I want to see if we have any questions. So let me see if I can get the chat open. No, I can't get the chat open. Can I ask for anybody who happens to be in the back room, have any questions been submitted?
Let's see. Bob asked about the recording and handouts. The recording for this presentation will be up on Timing Research within as soon as I can get it posted.
Okay.
Haley asked, do we need to start the trial right away, or can it be delayed for a period?
Yes, it can be delayed for a period. What I would say to those of you who are on the call, if you're looking for an actual copy of my presentation, you can drop me an email. That's my email address right there. and I'll be glad to send it to you. I would ask you that you reach out to me sooner rather than later, because I will be actually retiring. The benefit of being a better investor, I get to retire. So I certainly want to share the information with you, and with this recording that's being made available through this company, you'll be able to listen to the recording and follow along with the charts. So I'm sorry, Dave, were there any other questions?
See, my hardest part of projecting sales is finding analysts that project out further than 1 year. Any help or idea on this?
Oh, so, I understand exactly what you're saying. Some analysts will only do a year. Some analysts will go out 2 years. I think Value Line goes out at least 2 years. CFRA, I think they just do 1 year out. They might do a little bit more. So I agree with you. It's hard to get out, to find somebody who's going to forecast out 5 years. But it's, the point is that it's still better information than none at all. And the reason why I say that is, companies, they have their analyst days and they're meeting with analysts and so on and so forth. So they actually make information available to analysts that they may not make available to individual investors, with one exception. If the company posts the presentations that they make to analysts at the various analyst days on their investor relations website, very frequently I will go up there and look for those presentations, because they give me a greater sense for what the strategy is of the company, and so on and so forth. And not only that, it's done in view graph form, and it tends to be more visual, so it helps me kind of flip through the stuff I'm not interested in and just zero in on sales growth or strategy, and so forth, so that I can kind of understand the company a little better. But yeah, no, that's a good question, and I think it's one that we're always struggle with a little bit. Yeah. Okay.
And Haley asked, since you're retiring, is there would you like them to speak with someone else about the delayed or the trial or anything, or can they still
Yes, of course.
just contact you?
Yes, well, you've got that bit.ly. So let me put this write down this bit.ly web address down at the bottom. So it's http://bit.ly/BIWTI90. If you just enter that into your browser, I can tell you for the rest of the year, for the rest of 2020, that will take you to a landing page where you will be able to sign up for this trial offer.
Oh, okay.
You have to do it right away. Yeah.
Okay, so yeah, they can hang on to that link, and whenever they're ready, they can sign up. And that link will be in the. I just put it in the chat, but it will be on the archive page on Timing Research as well. I'll link to that.
Excellent, thank you. Really appreciate that. The other thing I would say, if people want a copy of my charts, and you for some reason get sidetracked and aren't able to reach out to me, within the next week or so, you can contact our contact center. I'm going to give you the toll-free number. It's 877-275-6242. That's 877-275-6242. And I will make sure that all of our member service representatives that staff the contact center have an electronic version of my presentation, so they can very quickly send it to you. You'll just obviously need to give them your email address.
Bob asked, do you use any technical tools?
I do not. But what I would say is, Better Investing is an organization of approximately 31,000 members. We're located around the country. About 80% of our members participate in an investment club, but then there's that other 20%. And I would also say that a lot of our members take, the learning that they get from their investment clubs and they apply it to their own personal portfolios. And so there are certainly some members in our organization that once they have done their fundamental analysis on a company, so this analysis that I just did, they will take a look at different technical tools to refine their analysis a little bit. And that's really up to the individual if they want to do that. From my perspective, I'm not necessarily interested in trying to find the absolute best time in which to buy the stock. I'm looking to kind of just be generally right. Again, because I'm going to hold it for a longer period of time. But everybody uses this a little differently. But they start with the fundamental analysis that I just shared with you today. So very good question.
And Haley asked if they're looking for a investment club in the Surprise, Arizona area. Do you have like a directory of, or do you have a?
Yeah, so again, someone who's asking the question about trying to get in contact with an investment club in their area. So if you go to our website, www.betterinvesting.org, and you go to you'll be right there on our public page. If you go across the top, you'll see a tab that says something about our community. So if you click on there, there should be a link that says, find, the chapter near me. And so you'll input a little information and that will take you to your chapter that services Arizona. And when I say take you to that chapter, we'll take you to the webpage on our website that has all the information for that particular chapter. And that will identify if there's a model club in that particular chapter. Model club makes their meetings open to the public so people can join the model club and kind of see how it works and so on and so forth. And kind of work with that particular model club. You'll also see a list of clubs in Arizona that are open to having guests attend their meetings. So one thing to keep in mind about an investment club is that it's actually a business partnership. So you actually file, with your local state agencies and the IRS. And of course, the purpose of the club is to invest and to learn about investing through investing, by actually investing. But because each club is its own individual partnership, some clubs may decide that they only want to be a club of a certain number of members. And so they may have reached their limit. And so they're not interested in accepting new members. There will be other clubs that are interested in hosting guests, having guests join them at their meetings, so the guests can learn more about the club and investing and investment clubs and so on and so forth. And I'm just confident that once you kind of start that conversation with them, you'll have a sense as to whether or not you think that it's a club that would be a good fit for you. That was a long-winded answer about how to get there. I'm sorry for that. But go to the Better Investing website. Go look under our community. Look for the information that says finding a chapter near you, and that will help you get to the local chapter in Arizona and the various programs that they offer there.
Okay, and if anyone else has some more questions, we have some time left. Okay, well, I think that's it. So.
Okay, well, thank you everyone for joining me today.
Thank you so much, Kamie.
Great presentation. So
It was amazing, super interesting.
Okay, good. Good night, everyone.
great presentation to close out the event.
Yeah, super powerful.